A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
You know, Herman, I was looking at a spreadsheet the other day, just a standard business ledger, and it struck me how cold it is. It is just rows and columns of numbers. Revenue, expenses, profit, loss. It is clean, it is clinical, and it is objective. But there is a group of people out there who think that spreadsheet is missing the most important thing of all. They want to put a dollar value on the very concept of human goodness. They want to take the messy, subjective reality of our moral choices and squeeze them into a cell on an Excel sheet.
It is the ultimate dream of the technocrat Corn. If you cannot measure it, you cannot manage it. That is the old management consultant mantra that has dominated corporate boardrooms for 40 years. But what happens when you try to measure things that were never meant to be quantified? Our housemate Daniel sent us a prompt today that comes from a listener named Sarah, and she is really digging into something that sounds like science fiction, but is actually becoming a massive part of the global financial architecture. We are talking about the International Foundation for Valuing Impacts, or the IFVI.
The IFVI. It sounds like one of those boring regulatory bodies that no one pays attention to until they suddenly realize it has changed the entire way the world works. It is like the plumbing of the global economy. You do not think about it until the pipes start redirecting the flow of trillions of dollars. Herman Poppleberry, you've been diving into the history of this for the last 48 hours. Where did this come from? Because this is not just some fringe academic idea anymore. This is being discussed at the highest levels of the World Economic Forum and the G7.
Not at all. It actually started in the ivory towers of Harvard Business School back in 2019. It was originally called the Impact Weighted Accounts Initiative, or IWAA. The idea was led by George Serafeim, a professor at Harvard who is basically the rock star of sustainable finance, and the legendary Sir Ronald Cohen. For those who do not know, Sir Ronald is often called the father of social investment. He is a British venture capitalist who basically decided that the next great frontier for capital was not just making money, but forcing capital to achieve social goals. He wrote a book called Impact, Reshaping Capitalism to Drive Real Change, which is essentially the manifesto for this entire movement.
So, the I was the research phase. They spent years developing these mathematical models to prove that you could actually take a company's environmental and social impact and turn it into a line item on a financial statement. They wanted to move past the vague, glossy sustainability reports that companies put out. You know, the ones with pictures of children planting trees and wind turbines in the sunset, and turn that into hard currency. And then, in 2022, they spun it off into this independent entity, the IFVI, which is based in the Netherlands.
And that move from Harvard to an independent foundation in the Netherlands is significant. It signals a shift from academic theory to institutional implementation. They are no longer just asking if we can do this, they are setting the standards so that every company in the world eventually has to do it. Sarah's concern, which I think is very well founded, is that this is not just about better accounting. It is about creating a new moral currency that bypasses the way we normally decide what is good for society. It is about shifting the power to define the good away from voters and toward a small circle of accountants and academics.
Right, because normally if we want to change how a company behaves, we pass a law. We have a public debate, we vote, and our representatives pass a regulation. It is loud, it is messy, and it is transparent. But the IFEI approach is different. It is about changing the math of capitalism itself, so that the regulation is built into the balance sheet. Before we get into the political implications, though, I want to understand the mechanics. How do they actually do this? How do you put a price tag on something like employee diversity or carbon emissions in a way that actually fits into a standard accounting framework?
That is where it gets incredibly technical and, frankly, a bit unsettling. The core mechanism is what they call impact weighted accounts. Traditional accounting follows GAAP, the generally accepted accounting principles. Those focus on financial capital, the actual cash moving in and out. The IFEI wants to create a parallel set of books for what they call natural, social, and human capital. To do this, they use something called shadow pricing.
Shadow pricing. That sounds like something out of a spy novel. Explain that for the layperson.
It is an econometric tool. A shadow price is an estimated price for something that is not normally traded in a market. For example, there is no market where you can go and buy a unit of clean air. So, how do you value it? You use models to estimate the cost of the damage done by a ton of carbon dioxide. They look at things like healthcare costs from respiratory issues, lost agricultural productivity due to weather shifts, and property damage from rising sea levels. They come up with a number, say $190 per ton of carbon, which is a figure the US government has actually used in its own internal modeling recently. Then they look at a company's total emissions and subtract that total dollar value from the company's reported profit.
Wait, so if a company makes $1 billion in profit, but their carbon footprint, according to this shadow price model, is valued at $200 million in damage, the IFEI would say their real impact weighted profit is only $800 million?
Precisely. And they do not stop at the environment. They have models for employment impact too. This is where the IFEI really pushes the envelope. They look at things like the diversity of the workforce, the safety of the workplace, and even the living wage. If a company pays its workers less than what the IFEI considers a living wage in that specific geographic area, that is counted as a negative impact. It is a cost that the company is externalizing onto society. So that gets subtracted from the bottom line too. Conversely, if they provide high-quality training that increases an employee's lifetime earning potential, that is added as a positive dollar value to the profit.
This is where I start to see the friction. Who decides what a living wage is? Who decides the dollar value of a diverse workforce versus a homogeneous one? If I am a business owner in a small town in the Midwest, I might have a very different view of what is fair or beneficial than a committee of academics in The Hague or a group of consultants at Harvard.
And that is the heart of the critique. In a traditional market, prices are discovered through the voluntary exchange of millions of people. If I want to buy an apple and you want to sell it, we agree on a price. That price reflects reality. In the IFEI system, prices are invented by experts. They are using social science research to assign these values. For instance, they might cite a study saying that a diverse workforce leads to 15% better innovation and therefore assign a positive dollar value to every minority hire. But that is not a market price. That is a value judgment dressed up in the language of mathematics. It is what we call scientism, using the trappings of science to give authority to subjective opinions.
It feels like an attempt to solve the problem of externalities, which is a real thing in economics. If a factory pollutes a river, that is a cost they are not paying for. I get the logic of wanting to account for that. But when you move from physical pollution into social engineering, like workforce demographics or corporate culture, the math becomes incredibly subjective. It is basically a way to codify a specific political worldview into a spreadsheet and then tell the world it is just objective accounting. It is like they are trying to create a god's eye view of the economy, but the people wearing the goggles have very specific biases.
Right, and remember, they are aiming for what they call the triple bottom line, people, planet, profit, but they want it to be a single bottom line. They do not want a separate sustainability report that people can ignore or treat as a marketing brochure. They want one final number that integrates everything. They want an investor to look at two companies and say, Company A made more money in cash, but Company B has a higher impact weighted profit because they have better diversity scores and lower emissions, so Company B is the better investment. They are trying to redefine what value means in the 21st century.
Which brings us to the policy bypass that Sarah mentioned. This is the part that really feels like a subversion of the democratic process. If this were just a voluntary thing for niche investors who want to feel good about their portfolios, maybe it would not be a big deal. But this is being designed to be picked up by the big players. We are talking about the BlackRocks, the State Streets, and the Vanguards of the world. If the world's largest institutional investors start demanding impact-weighted accounts, it does not matter if there is a law or not. Every CEO will fall in line because their stock price depends on it.
That is exactly the mechanism. It is what some scholars call private law. You do not need a majority in Congress to change corporate behavior if you can change the standards of the accounting firms and the mandates of the pension funds. We have talked about this before in episode 1324 when we looked at the dark side of impact investing. This is the logical conclusion of that trend. It is the institutionalization of a specific ideological agenda into the very plumbing of global finance. It is a way to achieve policy goals, like wealth redistribution or specific environmental targets, without ever having to win a single vote in a national legislature.
And because it is technical and boring, most people do not realize it is happening. If you tell the average voter that an international foundation is redefining what profit means based on a set of moral metrics they never voted for, they might be upset. But if you tell them that the IFVI is just updating accounting standards for the 21st century to better reflect long-term risk and intangible assets, their eyes glaze over. It is the perfect stealth maneuver.
It is brilliant in a way. It uses the prestige of institutions like Harvard and the technical complexity of econometrics to shield these decisions from democratic oversight. Think about the social cost of carbon. Depending on which academic model you use, that cost could be $10 or it could be $300. That difference could make a massive oil company look either highly profitable or completely bankrupt on an impact-weighted basis. Who gets to pick the model? The IFVI board. And who elected them? Nobody. They are a self-appointed vanguard of the enlightened elite.
It is a technocratic capture of the economy. And from a conservative perspective, or even just a pro-sovereignty perspective, this is deeply concerning because it undermines the sovereignty of the nation-state. If a country like the United States or Israel decides it wants to prioritize energy independence and supports fossil fuels, but the global accounting standards penalize those companies so heavily that they cannot get insurance or investment, the democratic will of that country has been effectively neutralized by a group of unelected experts in the Netherlands.
It is a form of global governance that bypasses the United Nations, bypasses national parliaments, and goes straight to the capital markets. And the IFVI is very open about their ambitions. They are working closely with the International Sustainability Standards Board, or the ISSB, which was created by the same people who oversee the global accounting standards used in over 140 countries. They are trying to make impact-weighted accounting the global default. They want to move from voluntary to mandatory by making it the industry standard that no one can afford to ignore.
I want to push back on one thing, Herman. Some people would say, look, the current system is also a choice. Ignoring the cost of pollution or the social impact of a company is also a value judgment. It is a choice to value short-term cash over long-term planetary health. Why is the status quo more democratic than trying to account for these real-world effects? Is not the current system just a different kind of bias?
That is a fair question, but there is a fundamental difference. The current system focuses on what is objectively measurable, transactions. Did you buy this? Did you sell that? How much did it cost? It does not try to assign a moral value to those transactions within the accounting itself. If we as a society decide that certain transactions are harmful, we use the political process to tax them, ban them, or regulate them. That is where the moral debate belongs, in the public square. When you move that debate into the accounting room, you are taking it away from the people and giving it to the experts. You are replacing the ballot box with a proprietary algorithm. The status quo is not perfect, but it is transparent. The IFVI system is a black box.
That is a powerful point. It is the difference between a transparent political fight and an opaque technical adjustment. And when things are framed as technical, the common man is excluded. You need a PhD in economics just to understand the footnotes of why your local utility company's stock just crashed because of a new IFVI weighting on their water usage in a drought-prone area. It creates a class of high priests of capital who are the only ones who can interpret the sacred texts of the impact-weighted ledger.
And let us look at the second order effects. If a company is being graded on these metrics, what do? They optimize for the metric, not the reality. We saw this in episode 852 when we discussed building a post-capitalist economy and the pitfalls of non-market metrics. If you tell a company they get a positive impact score for diversity, they will hire for diversity to hit the target, even if it is not the best move for their specific business needs at that moment. They are no longer serving their customers or their shareholders, they are serving the formula. It is what we call Goodhart's law. When a measure becomes a target, it ceases to be a good measure.
It is the metric fixation problem. Companies will find ways to game the system. They will outsource the high pollution parts of their business to private companies that do not have to report to the IFEI, or they will engage in the kind of reputation laundering we talked about in episode 987. The actual world does not get better. The spreadsheets just look cleaner. It is like moving the trash from your living room to the basement and claiming your house is clean.
And the IFEI methodology is particularly susceptible to this because it is so complex. They have these massive spreadsheets for different industries. If you are in the airline industry, your impact is measured differently than if you are in software. This creates an incredible amount of power for the people who write those industry-specific rules. They can effectively pick winners and losers in the global economy by tweaking a few variables in a hidden formula. Imagine the lobbying that will happen. It will not be lobbying for laws, it will be lobbying for weightings.
I am curious about the American context here. We know that under the Trump administration, there was a lot of pushback against ESG, which stands for Environmental, Social, and Governance Investing. The Department of Labor even put out rules saying that pension fund managers have to prioritize financial returns over social goals. How does the IFEI fit into that political landscape? Is it just ESG with a new coat of paint?
It is the next evolution of that fight. The critics of ESG argued that it was too vague, too subjective, and too prone to greenwashing. The IFEI is the response to that critique. They are saying, okay, you want objectivity? Here is a formula. Here is a dollar value. They are trying to co-opt the language of the skeptics by making the subjective look objective. But the underlying goal is the same, to redirect capital toward a specific set of progressive policy outcomes without having to win an election. It is ESG 2.0, and it is much more dangerous because it is much more integrated into the core financial reporting.
It is a way to make ESG bulletproof. If you can point to a Harvard-backed formula that says a company is losing value because of its social impact, then a pension fund manager can say they are just fulfilling their fiduciary duty by divesting. They can claim they are not being political. They are being prudent. They are just following the new math. It is a masterful piece of rhetorical and institutional engineering. It turns a political choice into a fiduciary requirement.
It really is. And Sarah's point about the democratic process is the most vital part of this. In a healthy democracy, we have messy, loud, and often frustrating debates about things like the environment and social justice. That is how it should be. We reach a messy compromise that reflects the will of the people at that moment. The IFEI approach wants to replace that messiness with a clean, expert-driven solution. It assumes that there is one correct way to value these things, and that the experts in the Netherlands have found it. It is the death of pluralism.
It is the ultimate expression of the globalist vision, a world where the important decisions are made by a harmonized set of international standards, and national politics is just a sideshow. If you control the accounting, you control the capital. If you control the capital, you control the world. It does not matter who the president is if the financial system has already decided that your core industries are a net negative for humanity, based on a shadow price model. You can vote for coal all you want, but if the IFVI says coal has a negative value of $500 a ton, no one will ever lend you the money to dig it up.
And we are already seeing this happen. The IFEI is partnering with organizations like the Value Balancing Alliance, which includes massive German companies like BASF and Volkswagen. They are building a coalition of the willing. Once they reach a certain critical mass, it becomes the de facto standard. Any company that does not adopt it will look like it is hiding something. They will be punished by the market, not by the government. It is a soft totalitarianism of the ledger.
So, what does this look like in practice for a regular person? Let's say you are an investor or just a citizen. How do you even begin to audit the auditors? If you see a company release an impact-weighted account, what should you be looking for? How do we pierce the veil of this objective math?
The first thing you should look for is the methodology behind the shadow prices. Ask where those numbers came from. Did they come from a peer-reviewed market study, or did they come from a social science paper with a clear political bias? Second, look at what is being left out. Metrics are as much about what you ignore as what you include. For example, does the IFEI value the impact of a company providing affordable energy to poor families? Or does it only count the carbon cost of producing that energy? Usually, they focus on the negatives and ignore the social positives of core business activities. They treat the product as a neutral thing and the impact as a series of harms.
That is a huge point. A pharmaceutical company might be penalized for its waste production, but not given nearly enough credit for the millions of lives saved by its products, because putting a dollar value on a life saved is even more controversial and difficult than putting a price on a ton of carbon. The system is inherently biased toward the things that are easiest to critique from a progressive standpoint. It creates a skewed reality where the most productive members of society look like the biggest villains.
It frames the corporation as a source of damage that needs to be mitigated, rather than a source of value that drives civilization forward. It is a very pessimistic view of human enterprise. It treats every business activity as a series of harms that must be weighed against the profit. It is a fundamental shift in the moral logic of capitalism. Instead of, what can I create, the question becomes, how much damage am I allowed to do?
And it is one that I think most people, if they understood it, would be very skeptical of. We have seen this movie before. Whenever a group of elites says they have found a way to quantify human values and manage society more efficiently, it usually ends with a loss of freedom and a lot of unintended consequences. We talked about this in episode 439 regarding the new rules of impact investing. The more you try to centralize these moral decisions, the more you stifle the natural diversity of a free society. You end up with a monoculture of approved values.
Right. In a free market, I can choose to invest in a company because I like their products, or because I think they are well managed, or because I share their values. In an IFEI world, those values are prepackaged for me. The market is no longer a place for diverse value judgments. It is a place for the execution of a single, unified value system. It is the financial version of the social credit score we see in other parts of the world.
So, what is the alternative? If we agree that companies should be more responsible, how do we do that without handing the keys to a foundation in the Netherlands? How do we keep the good in capitalism without letting the technocrats define it?
The alternative is the old-fashioned way: transparency and democracy. If you want companies to be more diverse, you make their diversity data public and let consumers and investors decide if they care. If you want them to pollute less, you pass a carbon tax through a transparent legislative process where people can debate the rate and the impact on the economy. You do not hide the policy inside the accounting standards. You keep the math clean and the politics public. We need to separate the how much money did we make from the is this good for the world? Those are two different questions that require two different types of thinking.
That seems like a much healthier approach. It keeps the responsibility where it belongs, with the citizens and their representatives. It prevents the technocratic bypass that Sarah is so worried about. But the momentum behind the IFEI is significant. They have the funding, they have the prestige, and they have the ear of the world's most powerful financial institutions. They are moving fast, and they are moving in the shadows of technical committees.
They do, and that is why we need to be talking about it. This is not just a boring technical update. This is a battle over who gets to define what is good for society. Is it the people through their elected governments, or is it a small group of experts through the global financial system? That is the question at the heart of the IFEI. It is a battle for the soul of the economy.
It really makes you think about the future of the corporation. If this becomes the standard, the very definition of a successful business changes. A company could be making a product that everyone loves and providing thousands of jobs, but if they do not check the right boxes in the IFEI spreadsheet, they are considered a failure. They could be hounded out of existence by institutional investors despite being perfectly profitable and popular. That is a radical change in how we organize our society.
It is the transition from shareholder capitalism to what they call stakeholder capitalism, but with a technocratic twist. It is stakeholder capitalism where the stakeholders are represented by a formula written by people you have never met. It is a very cold, very clinical way to manage a world that is inherently warm and messy. It replaces human empathy and local knowledge with a centralized algorithm.
I think that is a perfect way to put it, Herman. It is the attempt to turn the human soul into a balance sheet entry. And while the intentions might be good trying to make the world a better place, the method is deeply flawed because it bypasses the very things that make a society free: debate, disagreement, and democratic choice. It is a shortcut to a better world that might end up being a much more rigid and controlled one.
Precisely. And I think we are going to see a lot more pushback on this as it becomes more prominent. People are starting to wake up to the fact that these technical standards are actually deeply political. We have seen it with the pushback against the SEC's climate disclosure rules in the United States. The courts are starting to ask if these agencies even have the authority to impose these kinds of moral mandates. The legal battle over major questions is going to be the front line of this fight.
That will be the real test. When these standards meet the legal systems of sovereign nations, will the courts allow a private foundation to effectively set public policy, or will they insist that these decisions remain in the political sphere? It is going to be one of the most important legal and political battles of the next decade. It is about the very definition of administrative power.
I agree. And for our listeners, the takeaway is to stay vigilant. When you hear about new accounting standards or impact-weighted accounts, do not let your eyes glaze over. Look at who is writing the rules and what values they are embedding in the math. Because at the end of the day, no formula can replace the moral judgment of a free people. We cannot outsource our conscience to a spreadsheet.
Well said, Herman. This has been a fascinating deep dive into a topic that I think is going to be a recurring theme for us. Sarah, thank you for the prompt. It really forced us to look at the plumbing of the global economy in a way we had not before. It is scary, but it is better to know how the pipes are being laid.
Yes, thank you, Sarah. And thanks to Daniel for bringing it to us. It is these kinds of deep, structural questions that I love exploring because they reveal so much about where our civilization is headed. It is the weird stuff that actually runs the world.
And hey, if you are enjoying these deep dives and you want to support the show, we would really appreciate it if you could leave us a review on your podcast app or on Spotify. It genuinely helps other people find us and join the conversation. We are trying to build a community of people who look past the headlines.
It really does make a huge difference. We read all the feedback, and it helps us keep the show focused on the topics you care about. We want to be your guide through the technocratic wilderness.
You can find all our past episodes, including the ones we mentioned today, like episode 1324 and episode 852, over at myweirdprompts.com. We have a full archive there, and an RSS feed so you can subscribe however you like. We have got over 1,000 episodes of this kind of deep tissue analysis.
And if you are on Telegram, just search for My Weird Prompts to join our channel. We post every time a new episode drops, and we often share the source documents we use for our research, so it is a great way to stay up to date and do your own digging.
We will be back soon with another prompt and another deep dive. There is always something weird and wonderful to explore in this world, even if it is hidden in the footnotes of an accounting manual.
And there is always a paper or a report that needs to be deconstructed. Until next time, I am Herman Poppleberry.
And I am Corn Poppleberry. Thanks for listening to My Weird Prompts.
Stay curious, everyone.
And keep an eye on those spreadsheets. You never know what moral code someone is trying to hide in the formulas.
The math is never just math. It is always a story about what we value.
See you in the next one.
Bye for now.
You know, I was just thinking, Herman, if we were graded by the IFEI, I wonder what our impact score would be. A sloth and a donkey talking about global finance in Jerusalem? That has to be a positive for diversity at the very least. We are definitely hitting the interspecies dialogue metric.
Or a negative for productivity, depending on how long your naps are, corn. They might shadow price your sleep schedule as a loss of human capital.
Hey, my naps are essential for my deep thinking. The IFE, I just needs to find the right shadow price for a well-rested sloth. I am sure there is a Harvard study somewhere that says napping increases philosophical output by 20%.
I will get right on that. I will start drafting the methodology tonight. We will call it the Poppleberry Nap Weighted Account.
I knew I could count on you. All right, let's get out of here before they start measuring our carbon footprint from all this talking.
After you.
Actually, I think I will just stay here and take that nap. You go ahead.
Figures. See you later, Corn.
Bye, Herman. Thanks for the deep dive.
Anytime. This was a good one.
Truly, it is a strange world we are building.
It certainly is. But at least we are talking about it.
That is the first step. All right, signing off for real now.
Take care, everyone.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, my weird prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My weird prompts, that's the flows from sloth